Welcome to the Stock Market Stories podcast. My guest for episode 2 is Logan Kane. Logan is the author of High Finance, The Secrets Wall Street Doesn't Want You to Know. Logan frequently writes about quantitative investing and behavioral finance on SeekingAlpha. Today, I asked Logan about how to become a quant, market microstructure, his expose on Robinhood's payment for order flow practices, and several other things. Just tell me about how you got started, what created that initial spark, and I guess how you see yourself today as a trader, an investor, your basic strategy, these sorts of things.
All right. Well, first off, Pat, thanks for having me on. It's a pleasure to be with you. We talked a little off camera. You're a pretty cool guy. So I got into the financial markets. I started becoming interested in it around 2007. And then 2008 happened, and that was the year I actually started trading. So there was a lot of opportunity. There was a lot of volatility. I was 13 at the time. So I had come into a little bit of money from my grandma was buying savings bonds for me since I was a baby. So she gave them to me in 2008. So I started picking stocks then. Obviously, I started in late 2008. So I got hit first. I experienced the bear market first. But then I experienced 2009, and it was great. I started off as a bottom-up value investor, which we kind of discussed earlier. Since then, I've kind of moved into more quantitative stuff. I think it's better for a lot of reasons. Is there anything more specific you want me to answer?
Yeah, I think it'd be really interesting because you mentioned off camera about how, you went to school in South Florida and the kids that were a few years younger than you, they had their bar mitzvahs and they got a lot of money put in the market by their family, and that really colored their experience. So can you tell us a bit about that and how that initial sentiment you get with the market might really influence your future?
Yeah, so I actually grew up in Missouri. But then I ended up going to college down at the University of Miami. And you did see this. So the kids who are my age, most of them are in my grade. Most of them had their bar mitzvahs after the crash. So they were able to buy really low. And the kids who are a couple years older than us, they bought into the market before the crash. So the people who are my age had a lot more assets than the people who are a couple years older. It's a really interesting, little sociological piece to it. And the difference was often $20,000, $30,000, $40,000 that the kids were getting. I thought it was really interesting, and I obviously I'm not Jewish, but I also bought into the markets as they were crashing, and I added more money when it was at the lows. So that really did affect my experience of the markets. I thought there might be something there. I still remember I was in 7th grade and I'd just gotten into the markets, and it was April 2009. I owned a bunch of Bank of America stock. That was one of my first picks. And I made $600 in a day. And I was like, this is cool. Because I was 13, and it was like, okay, this is cool. I had my parents set me up one of those UTMA accounts. So it was in their name, but they gave me the login so I could control it. And it was under my tax returns. Nice little things. If anybody has kids who are teenagers and are listening to this, you can set up these accounts and you can just give your kids the login and they can trade. Anything else you want to ask about? Sorry, I go on these tangents, Pat.
For sure. So it was really interesting how you mentioned that initial stock pick that worked for you. That sort of colored your experience going forward. Do you think maybe if you started just a year before and got hammered, do you think you'd be where you are today?
I do, because I got into the market as a bottom-up value investor. So had I started earlier, I would have done okay. But I don't know, because that Bank of America trade was pretty good. I bought for 4 and I sold for 15. And I had a lot of shares too. It was half my account. So I made I made 5 figures on the trade. I remember, and it was great. I don't know. I obviously we'd have to replay history to know that. I think there's definitely a lot more interest in the financial markets for people who are my age and a couple years older. Rather, people who started investing after the crash, they like the financial markets more than people who started investing before the crash. There's just that path dependence to the markets that kind of affect people's opinions.
Right. So you mentioned you started as a more traditional bottom-up value investor, but now when you read your Seeking Alpha posts, you're very much more of a quantitative investor, it seems. Can you describe that shift and how it happened? What maybe influenced you?
I can. So, obviously when I started, it was very fertile ground for doing that kind of value investing. Now, not as much. My progress wasn't necessarily linear. Like, I traded a lot my first 5 years I was into it. I took a couple of years off, and now I've gotten back into it kind of as a researcher and a writer for Seeking Alpha. The idea is going forward, I'd like to do this as a business for something where I can have in excess of a 95% chance of making money in any given year. The kind of thing where you have other sources of income, but it's a business. Like, you can support yourself, you can support a family off it. And it sounds like a lot of people think that's not necessarily easy. Like, anybody who's a market maker can probably tell you that that's their experience. A typical retail portfolio might make money, 60, 70% of the time, but a professional market making portfolio would be a lot more efficient. My favorite time frame is actually 1 to 3 months on the quantitative stuff, which I think works really well. It's kind of a nice compromise. So I don't necessarily want to or need to invest in a bunch of infrastructure. You read about these co-located data feeds and stuff like that. And I don't want to get into the high frequency game. The way that I approach the markets is to take advantages of biases and constraints of institutional investors. So the idea is we look for imbalances in supply and demand, and we meet that supply and demand. I can explain more if you want. I can give you some examples.
Yeah, some examples would be great.
Okay, take the options market on the S&P 500, right? You get this thing called the volatility skew. So if you want to sell an option if you want to sell a call on the S&P 500 for a little above where it is, the implied volatility is really low. There's lots of sellers and there's few natural buyers. But if you want to sell a put below the price of the S&P 500, the implied volatility is pretty high. There's lots of buyers and there's few sellers. This is because of bias and constraint of investors. They don't want to expose themselves to risks that their investors don't like. And they all tend to do the same things, and they herd. So the implied volatility for a put on the S&P, say 3 or 4% below the money for 1 month out, might be 50% higher or even double the implied volatility of a call a month out. That's 2 or 3% out of the money. These options are nice because they can really easily show you where these constraints are. And there's other reasons why there's the volatility skew, but this explains about half of it. It's really technical, some of the reasons. Out of the money puts are really difficult to hedge. So the volatility is considered to be higher on a delta hedge. So you need that skew you need the volatility skew to compensate for it a little bit. But it's kind of outside the scope of this. Really, other interesting areas where we see biases and constraints, I have a lot of them. But investors tend to herd to the same things. They like stocks that are large, popular, like Dow 30 stocks. And you can actually see, if you look in the data, if you control for all the other factors, which is a little trickier than it sounds, the returns of small stocks are bigger than the returns of large stocks. And the reason this is because all these mutual funds, all these households in the US, they all go buy popular stocks. And the more visible the company, typically the lower the return for the level of risk. It's a pretty subtle effect, but it's an example of a bias.
Right. That's really interesting. So
Yeah.
you talked about how your main time frame is 1 to 3 months. So are you primarily playing off of flows and funds? Is it how much does things like technical analysis play into it and things of these nature?
Yeah. So what I do is I build econometric models to predict some of the stuff. So like, for example, on the S&P 500, I have a pretty simple model. And the inputs are the risk-free rate of interest, volatility, and the return forecast. None of the forecasts are super strong individually, but together they're pretty good. The idea is we can make a decent forecast for the risk-adjusted return of the S&P 500 over the next month. And like I can explain how each factor affects it. Like the returns, I can only predict 20% of the returns with the model, but we can get a pretty good guesstimate based on the long run returns. So like the long run average return of the S&Ps are a little less than 10, and I can confirm this just by valuing the asset. Like based on the PE multiple and our expected GDP growth, we can expect about 9.5% returns for equities. If people who are listening to this want to know how I do this, I use a modified Gordon growth model to value equities. The idea is that valuation and expected growth within a reasonable band is indicative of the returns that we'll see over a 10-year period in the S&P. And this is pretty accurate historically. So we see about 4% growth, and we see that the earnings yield of the S&P, I checked it last a few weeks ago, is around 5.5%. So that's how we get that 9.5% expected return. The interest rate forecast, something that's really important for a quantitative investor is whether you could beat the returns of the market by investing in cash. So one of the things when the Fed puts interest rates really low is equities are good. And in particular, what you can do is you can short cash to buy equities. You can lever up. So interest rates, it's a little difficult to explain, but like in a futures contract, like the risk-free rate of interest is already priced into the contract. Like if you just have a portfolio, the idea is that by investing in stocks, you're giving up the risk-free rate of interest. So it always matters for portfolio construction. Like if the risk-free rate of interest were 6% and the expected return on stocks for 9.5%, I would tell you that at a minimum, we would want to take less leverage and we would want to reduce our position size. Does that make sense?
Yeah, that does. One thing you said was short cash. So when you say short cash, you mean leverage?
Precisely. Yeah. And this is shorting cash is a very common strategy of quants. Usually you'll see a gross position size in excess of 100%. And this is tricky because a lot of retail investors are not going to be able to implement this. The way you short cash is you use derivative products like futures and options. You can't just go to E-Trade and borrow money for 9% because you're not shorting cash. You're shorting a debt security that's pays them 9%. Actually, it's like 12 now. It's ridiculous. But they have $20 billion worth of suckers who borrow on margin with them. They just don't know what they're doing. They're just households, typically young, affluent households. They like to borrow on margin. It's just not a good idea the way they do it. The interest rate really matters because I have models, and maybe when we put this online, you can link to some of these. But so the optimal leverage that you can use is actually known based on the return of the asset and the return of the asset and the interest rate you can borrow at. So this was actually solved by this mathematician named John Kelly in the 1950s, and Ed Thorpe built on it. He's the guy who popularized card counting. He had a very successful hedge fund. It might still be open. He's in his 80s now, but I'm a big fan of the work of Ed Thorpe. A lot of the guys who founded PIMCO and who built PIMCO up, they were big proponents of Ed Thorpe's work. They all live in Newport Beach in California. Yeah, and I think I kind of trailed off. We were talking about the model for the S&P. Volatility is another big thing. So a lot of people think that you can't predict volatility, but you actually can. Volatility is actually pretty easy to predict over a 1 month period. And the reason why this matters is because in one of my models, what I do is I apply some stuff that card counters use, and I apply it to the stock market. The idea is if we can't really predict the return based on past month's return, we can only weekly predict it based on valuation. But over the next month, I can pretty accurately predict the volatility. So the idea is we adjust the leverage based on the amount of volatility to try to keep our risk exposure constant to a target. And by doing this, you can beat the market by around 4% per year, just on that alone.
Gotcha. So before you mentioned, was it the Kelly criterion you were referring to before?
It's a modified part of the Kelly criterion. I think it's a Taylor series. It's a calculus thing that they use. But if people are listening to this and they want to write it down, the optimal leverage is the return of the asset minus the borrowing cost, and you divide that by the standard deviation squared. So, yeah, like for the S&P 500, since I think 1928, I believe that would get you around 3 times leverage is optimal, like a little less than 3.
Gotcha. And you say it's better to lever through derivatives than it is to borrow on margin. Can you, in maybe layman's terms, try to explain why that is?
Yeah. So derivatives products are wholesale products. So you're getting the risk-free rate of interest. Like for futures, they're neutral to buyers and sellers. The borrowing on margin is an over-the-counter product, meaning the seller controls the price. This is important because for futures, the interest rate is typically below LIBOR or at LIBOR, depending on the product. Like S&P, I think will usually trade a little rich to LIBOR, so maybe LIBOR plus 10 basis points. If you borrow on margin from a retail broker, you're typically looking at 9 to 10% interest. So it completely wrecks the trade. Like you could just plug it into the model. So 9.5% expected return minus 9% interest rate is 0.5% you'd expect. And I don't even know what you would put for the volatility, but the leverage ratio would be less than 1. It wouldn't support it.
So you're saying borrowing on margin in general is sort of just a losing proposition?
It is extremely dependent on the interest rate that you pay.
Right. And is there, in your experience, variability? So you mentioned E-Trade before, and maybe 9-12% they're charging. Is there other brokers that offer better rates in your experience?
Yeah, Interactive Brokers is typically thought of as the best retail broker for borrowing on margin. I think they're at like LIBOR plus 150 basis points, or Fed funds plus 150 basis points maybe. It's still not good. It's still, if you're a hedge fund, you're typically LIBOR plus 25 to 50 is what you borrow for. And that's for like long short strategies. Derivative products are always going to be better. They're just cheaper. And that means it's very easy. You just go, if any broker that can handle stocks can usually handle futures. So you buy the product, the interest rate's embedded in the product, and you just go on your way. And this is how a professional would trade as opposed to a retail trader. So, you can still take positions in individual stocks. It just costs you capital to do so. And unless you have a good prime brokerage relationship, a lot of those strategies are not feasible. Well, one of the themes in my research is that leverage plus diversification is better than concentrating risk in individual stocks. Like looking back, like I did very well in individual stocks, but if you look back, I beat the market, but I took more risk than the market. So I don't necessarily know if my Sharpe ratio is better than the market, but by using leverage and derivatives as a professional would rather than an amateur, you can really beat the market. You can. It's one of the ideas of modern portfolio theory. So the idea is you maximize your risk adjusted return, and then you apply more risk to that to equalize the return to whatever volatility you want. So like if I had a really safe strategy, I could lever it up and I could crush the stock market with it. It's the idea.
Right. Gotcha. So a big theme of what you've been saying is that retail investors and traders, they, from the start, maybe have a lot of things wrong, which really affects their returns. Can you explain simply what you think small tweaks are that retail traders and investors can make, and maybe the main differences between someone like you and someone who is trying to do some sort of long short strategy but in like an E-Trade type of account, and how that might be flawed?
I mean, if you're trying to do a long short strategy with E-Trade, you're probably going to lose just because you're not getting margin rebates like on the short interest. And I just you can't pull that strategy off in E-Trade just because the brokers pocket the interest income, and you don't get any. So you just kind of take a bunch of risk for nothing. But as far as retail traders go, I could point to a couple of effects. There's one called the disposition effect. The idea is pretty simple: is that when a stock goes up, retail investors sell it, and this includes mutual funds. They tend to sell it. And when a stock goes down, they hold on to it. And this really affects asset pricing, because what it means is that investors tend to underreact to new information. So what you get is the stock like Apple, it's up over 200 times in the last 20 years, right? Maybe not the last 20 years, because 1999 was a good year for Apple, but the last time period I looked at, it was up over 200 times. What happens is Apple is going to take over your portfolio. So what do? You sell Apple and plow it into your other stocks like GE. You buy some Ford, you buy some AIG, Citibank. A lot of people did. And the idea is that the winning stocks tend to keep going up and that losing stocks tend to keep going down. And this is the number one reason why retail investors underperform. It's like, I'll ask you a question, and I think your listeners will find this interesting. So what do you think? We know the average return of the market, right? Around 9.5%. So what do you think the return of the median stock is in the S&P? Not the S&P. Let's say the Russell 2000 per year.
Maybe 5%. Let's say.
Yeah. So it's actually a little less than 5%. So it's pretty accurate. The idea is that maybe 15% of the stocks in the whole market make up 80 to 100% of the gains. And what you get is you get a lot of stocks that tank. You get the median stock returns a little bit above cash. And then 1 in 7 stocks returns over 20% per year. And this is it's very interesting because you look at the average retail portfolio of the average retail investor, and I don't know, maybe they have 5 to 10 stocks, and what they do is the one stock of theirs is going to go up 20% per year, and they're just going to sell it, and they're going to plow more into the stock that's underperforming, and the underperforming stock just doesn't come back, and the stock they sell keeps going up. This isn't universal. Like sometimes you do get these turnarounds, but just as a general rule, this disposition effect is a huge wealth transfer. And it's linked to the momentum effect in equities. So it's just what we see is underreaction at first in stocks. Like a stock like Apple, when the iPod came out and the iPhone came out, it was always the year behind the fundamentals. So the stock just kept going up. And retail investors would just sell. I mean, some of them held on, but it's a very interesting piece of portfolio construction. I think the average retail investor might return a little higher than cash. And that's just unacceptable. I mean, you can't take a ton of risk and earn 4% per year.
Right.
You know?
Right. So it seems like there's a lot of overlap with the short-term trading world. You know, one of the biggest principles you read in trading books is add to your winners and cut your losers short. So would that be an accurate thing that retail investors could change and really augment their returns?
Yeah, that's good advice. If you're picking individual stocks, that's good advice to let your winners run, especially in technology. The problem is with that kind of portfolio, and the reason I don't necessarily like picking individual stocks is because you get concentration risk out of this. Like, let's say Apple does take over your portfolio. Let's say you had a $200,000 portfolio in the 90s. You bought, I don't know, 50 grand. That's too much. Let's say you bought 25 grand worth of Apple and you sat on it. Now it's worth 3 million, right? So the rest of your portfolio is worth, I don't know, 400,000, and your Apple stock is worth $3 million. So your portfolio is 90% Apple, something like that. That's concentration risk. Your portfolio becomes Apple. So managing that concentration risk is key. And what you typically want to do is you want to set an allocation that you're comfortable with. And what I say, if a stock wants to take over your portfolio, you just let it. But you can strain it to a certain amount of your net worth. So I wouldn't want more than 40% of my net worth in Apple. I wouldn't invest 40% of my net worth up front, but if it wants to take over and make you money, like you have to let it. And then as it gets higher than 40, as it goes up to 50, 60, the idea is that you sell it and you diversify into the broad market indexes, not into your losers. And you can also make new stock picks with that. You can try to invest in new companies. I think a lot of early stage technology companies just end up being private now. It's harder now than it was before to invest in cool companies that are doing cool things because they don't go public. They don't want to deal with the public markets.
Right. That seems to be a really popular sort of trend that we're seeing in the last few years with all these unicorns that don't go public until, you know, they're way too expensive. So do you see that as maybe a warning sign for public investors in that the amount of good opportunities available to them is declining with, you know, the efficiency of private financing and the difficulty of being a publicly traded company?
It's a problem. I don't think you should necessarily quit trading stocks because of it. It's annoying if you're a public markets investor because you don't get to hang out with the cool kids. Like, it's somewhat of a problem. Like, I wouldn't be too happy about it if I ran like a small technology investment fund and I had to invest in public equities. I mean, it also keeps you out of some dogs like Uber. The idea is when a lot of these companies are these venture capital darlings and they finally come public, you should be kind of skeptical, at least until the lockup expires, because the supply and demand is just often not that favorable in the first 6 months. So you gotta let all these people sell. I don't know if you saw Beyond Meat yesterday. It's crazy overvalued. I was talking with my dad. And we were just having lunch. I'm like, the stock's going to go down 20% tomorrow. He's like, no way. I'm like, yeah, it's going to go down 20% tomorrow. And it was down like 23%, something like that. Just because all these people who work for the company can finally sell. It was worth $3 a share a year ago. Like, you'd be an idiot not to sell that. The company doesn't make any money, you know? And they can sell for $90 a share. Or I don't know what they got at the open, but $80, $90 a share. Yeah, you take that straight to the bank. You pay off your mortgage. You pay off you pay off any debt that you have. You fund your retirement and you walk away.
Right. I think that's a good shift into my next question. See, you seem to have a very modeled way of viewing the market, and it seems like a lot of these questions that even really big investors might have, you have a sort of a systematic way of looking at them. So with that being said, how would someone that maybe they're a bottom-up value investor, maybe they're a swing trader of sorts, how do they start to develop that systematic, that systems thinking that you seem to have? How do they start modeling the market, get that quant state of mind? Where do you start? Someone that's just trading classical chart patterns or just investing in things they know?
I mean, they probably won't, to be honest. Like, let's say we're playing fantasy football, Pat. Like, there's two ways you could approach this, right? So, I could build a quantitative model on fantasy football that says we want these players with these characteristics, and then you could analyze the teams and you could handicap and you could say, all right, so I think this team is going to do better than that team. Like, take the Cowboys, right? So you say, all right, I think Dak Prescott's going to have a good game because the secondary can't match up on Amari Cooper, and therefore I'm going to play Amari Cooper in this game, right? And there's not necessarily, like, you can be successful with both approaches. Like a bottom-up value investor, a lot of people like that, they come from investment banking backgrounds, who end up running value funds. A lot of them go to Columbia for graduate school in New York. That's where Warren Buffett went. And Ben Graham taught there. So that's where kind of the value investors are. And it's a certain culture that they approach investing with. Now, a lot of these quantitative people come from outside of finance. They usually come from academia. And it's just a very different view of approaching the markets. Some of them will get themselves in trouble if they don't have good economic intuition and they just try to apply machine learning or statistical analysis to the markets. They can get the wrong ideas sometimes. I could probably give you some examples of that. I mean, I would say for the average retail investor who is trading, I wouldn't try to fight your personality, or I wouldn't try to fight the way that you're trading, but I would want to have good knowledge of some of these behavioral economics themes, like the disposition effect, the momentum effect, post-earnings announcement drift, like just asset pricing patterns that we tend to see in the markets. And these can kind of inform our trades. Does that make sense? Yeah, so like if you're picking individual stocks and you have an individual stock portfolio and you know about the disposition effect, just knowing about it is likely to help your returns. And knowing about, like, I know in your email you mentioned market microstructure. I mean, the amount of fund managers who even know anything about market microstructure is pretty low. And that's a pretty important thing. We mentioned Ed Thorpe earlier. He ran a $500 million hedge fund. I think it might be a family office now. I'm not entirely sure. But their average trade size was like $80,000. And that's because they have a very good understanding of market microstructure. So if they're placing orders, they're selling $80,000 at a time and reloading every 7 seconds. And you get a better price if you do it that way. Even if you're somebody who has $10 million in Vanguard, just knowing how ETF market making works. I have a good article on that we should link to for the readers or the listeners. Just understanding how order flow works. Understanding, do I use a market order, a limit order? The proper way to do it is to use a patient limit orders or immediate or cancel limit orders. And it's pretty theoretical why this is, but I can explain it more if you want.
Yeah, I'd like to come back to market microstructure in a second, but
okay,
I think it'd be really constructive if so you, as you said, you started as a value investor. Somewhere along the line, you became more of a quant type of investor. Assuming someone wants to take that path, how do they start?
How do you go from a value investor to more quantitative? Well, the products you're going to trade are likely going to be different. So you're going to probably go from a bottom-up investor to a top-down investor. And that means your views are going to be less about individual companies and more about the relative performance of bonds, of stocks, of asset classes. So you start trading different products. You start viewing the world in a different way. And I think it's positive because it's ultimately less work and you can make more efficient forecasts than you can with individual stocks. Like if you're a long short hedge fund manager, you're under constant pressure to come up with good ideas. And that can be hard. Like if people are expecting you to deliver all the time and come up with great new ideas, I mean, what happens when the valuation environment changes and there aren't a lot of great ideas around? Are you going to give back the money? Are you going to say, hey, we're just going to invest in the S&P for the next 24 months? Like typically what happens is they swing at poor opportunities for the best they can find, which I don't think is a great strategy. There's a lot of conflicts of interest in that with just asset managers, and that's one of them. So I would say if somebody wants to go from value investing to more quantitative, I would say shifting the time frame shorter but not too short, and trading macro products rather than trading individual stocks are probably the two shifts you need to make.
Right. Is there maybe a book or a publication to start following to get people to start thinking in this mindset?
I mean, I can kind of tell you who I read. There's a lot of good old articles by Wilmot Magazine. I'll read a guy named Aaron Brown. He was the head risk manager for AQR. He used to work for Morgan Stanley. I read anything by Ed Thorpe is a good read. He was that hedge fund manager I mentioned earlier. AQR has really good research. Their options research in particular is really good, but you have to know how to interpret it. PIMCO has really good research. A lot of the good stuff in like quantitative investing comes in the form of research papers rather than books. That's just kind of how it is. And I'm sure there's more stuff that people keep proprietary, but usually somebody will, if it's an asset pricing effect, usually somebody will have written about it. At least if it's the time frame longer than a couple of weeks. So I mean that's who I read, and people can always follow me for this stuff because I kind of curate a lot of the stuff that these, I take a lot of the stuff that these 150, 160 IQ like professors and like quants write, and I kind of simplify it so that pretty much anybody can understand it. Because it is really complicated, and sometimes I'll have to sit down for an hour and just sketch stuff out and try to see what they're doing. I rarely understand the math and some of the more advanced like papers that I read, but the underlying theories I can usually work out.
Gotcha. I think that's a really good path for them to take. So you would say rather than seeking out books or podcasts, maybe just go straight to the source, that the people that are deploying these strategies themselves are going to be publishing a lot of research on them?
Yeah, a lot of times like they won't want to tell you everything because they don't want to make their strategies they don't want to hurt their strategies, but usually somebody else who's doing something similar will tell you another piece. And then you can put the puzzle together by reading about it from different perspectives.
Gotcha.
I kind of like the gospel according to Ed Thorpe, I guess.
Cool. So,
yeah.
Earlier you mentioned market microstructure and how it's vital for not only traders but long-term investors to understand. So I don't think anyone that is just buying some Apple or Google has even thought about this type of thing. So I guess to start out on this topic, what are some really practical, basic things that people can do to maybe reduce the negative effects that they experience through their regular trading? Like what are some basic things that almost everybody should know about market microstructure?
Okay. Yeah. So one of the first ones is market orders tend to be problematic. Particularly if you submit a market order before the market opens, you don't know what price you're going to get. And sometimes market orders can be fine, but typically you're going to pay a little higher price than you would otherwise. Typically you're going to pay the ask at a minimum. Another issue that's kind of common is stale limit orders. So if you just let a limit order sit, it becomes a liability. And I know you mentioned in the email the strategy that we used to employ on Tesla and Netflix, where we would submit limit orders before the market open. I probably did this 25 times, and we probably won like 16 or 17 times. But I think this is problematic because the idea is that informed limit or like informed order flow that comes in, or if news happens, your order's going to sit there. So you have an adverse selection problem. What they'll do is what that means is if the stock's going to go, if an event happens that's going to knock the stock down 5%, you're going to sell to them along the way or buy to them along the way. And it's not going to be favorable to you. And for this reason, high frequency traders use orders called immediate or cancel, so they don't get caught offering people stale prices, which offering people stale prices is not good. People can take advantage of you if you do it. I'm trying to think. So yeah, like I say that there's these things called patient limit orders. It's a good idea for a retail trader to do. So the idea is if, let's say Apple is trading for, I don't know, $245 or whatever it's trading for today. So I just put in an order 10, 15 cents below where it is and see if it fills. And then if it doesn't, you get up, you get a cup of coffee, and then if it doesn't fill, you cancel the order and then you submit a new one. The idea is that no news flow will come during the time in the interim, and you can get a little better price by using these patient limit orders. It sounds kind of weird, like all this market microstructure stuff, but it's important because every single trade you make is affected by this. So you really need to have a systematic process for how you do orders. Because I remember when I was first starting out trading options, I didn't think about this much. I mean, I knew limit orders were better, but I would just submit market orders for options, and I would just get, if you're selling into the order flow in the same direction as everybody else, you're not going to get a good price. And there were times when I'd be like, how did I get this price for this option? Like, how did this happen? Like, this cost me like $150, like just on a silly little order, like based on where it was before, where I sold it for, and where it is now. Like this money magically disappeared. And the answer is that it goes to the market makers because they have a better understanding of market microstructure.
Right. So diving down a bit deeper. So basically you say a long-term investor, the best thing they can do to negate the negative effects of this is providing liquidity over taking liquidity. Is that correct?
Mm-hmm. You'll do a little better if you offer liquidity.
Gotcha. Now, moving further, let's talk about traders. You know, people that are doing a lot of turnover. What more minute things should they know about market microstructure?
Yeah, there's these orders called immediate or cancel, and I think you have to use them if you're going to be successful as a trader. It depends on what size you're trading. That immediate or cancel will work if your account's less than, I don't know, $5 million. If you're trading institutional level money, you need an algorithm. So like banks have certain algorithms, interactive brokers have some good algorithms. The idea is that you break up your trades and you submit them $50,000 to $100,000 at a time. And you just have an algorithm that feeds it. And you feed these immediate or cancel orders. That way you're not moving the market when you trade, or you reduce the amount that you move the market. There's a lot of papers on minimizing transaction cost. And there's a lot of very, very smart people who work on this. It's an area where wealth is transferred if you're inefficient with how you trade. So I would say if you're another area where market microstructure is a problem is with ETFs. There's hidden transaction costs in ETFs. I'll use the example of football. Not a lot of people know this, but so the bid and the ask price for an ETF is not necessarily the net asset value. What they do is they adjust the price based on which way the market flow is going. So if everybody's selling, they're going to make the price lower of the ETF. And if people are buying, then they're going to make the price higher. And the reason why they can do this is if they can predict order flows reasonably well, they can make more profit than the bid-ask spread. It's like with bookies, like in sports betting. If they know which way people are going to bet, they can slant the line against them. Market makers on ETFs do this very effectively. And a lot of these market makers are like these firms like Citadel, they employ very smart people to determine order flow. And they know how to exploit the retail investor. And this just doesn't show up. It doesn't show up at all. But let's say you take the QQQ, that's the ETF that tracks the NASDAQ. So it's only going to track the NASDAQ to 10, 15 basis points every day. The difference is often captured from the order flow. This is one reason why I think, ironically, mutual funds can be better for small investors than ETFs. And I only know this because I've tested it. You would think that mutual funds would be more problematic, but a lot of times they have a lower total cost and volatility to the investor.
Right. So you mentioned how sometimes ETFs would be trading at a discount or premium to net asset value.
Mm-hmm.
So is the way that market makers, how do they capture that spread?
Well, I wrote about it in an article. It's pretty complicated, but the idea is that, let's say on an emerging markets ETF, right, Pat? The underlying stocks, like the bid-ask spreads, are 0.25%. Let's just not that high, but let's say they're 50 basis points or 25 basis points. The full bid-ask spreads. The idea is they don't have to pay the full bid-ask spread on each trade. Now, how can the underlying ETF have more liquidity than the components? The answer is that they're slanting the line to make money. It's a little difficult to explain, just because it's a new concept to a lot of people. But the idea is that they set the price of the ETF where the average order that comes in is going to is going to either pay a premium or a discount to the net asset value. And if you try to take advantage of this, if you try to beat them at their own game, this is a high frequency trading strategy that's pretty popular. It's to try to beat that, is they will widen the bid-ask spreads, or they will adjust it so that it's very difficult to beat them. Does that make sense?
Yeah. So one thing that I'm a bit confused about is when let's say the market makers move the ETF down so that's trading at a discount, are they creating a model portfolio and shorting it of the components to capture the difference between the discount and the actual net asset value?
Oh, so yeah, there would be an arbitrage relationship between the underlying components and the ETF. That is, if you were to beat them, you would do that. But it's the reason why it's difficult to beat them is because the bid-ask spreads are usually wide. It's tricky. It's very tricky. But for most people, I don't have enough knowledge to construct a high frequency trading program to to fight the market makers on this and pick them off. I think somebody like Renaissance might. The important thing to know is just that if you're selling an ETF below its net asset value, you're paying additional transaction costs, right? And because investors all do the same thing, it's typically when you're going to want to sell is when they're going to offer you a shitty price. Like when the market goes down, you can usually bet that that stuff's going to trade at a discount. When it goes up, it'll just trade at a slight premium or a fair value. So the liquidity is just not as good as it looks.
Right. Okay. Yeah, you clarified that well. So when talking about market structure, something that really often comes up is the idea of payment for order flow and internalization. Now, I think it was around November of last year, if I'm not mistaken, you published an article about Robinhood's payment for order flow practices, and it really blew up all over the internet.
Yeah.
So, yeah, can you just tell us a bit about that? And did you expect that to happen? And maybe the results of your article and such?
No, I didn't expect it to blow up. I mean, obviously, it got a lot of attention on SeekingAlpha. Then Bloomberg picked up the story, and the Wall Street Journal picked up the story. They were talking about it on CNBC the day it was published, which was weird. Like, it was interesting. Basically, how Robinhood makes money is, remember I said investors have all these constraints and biases, and they suck at investing. So what the high-frequency traders who do business with Robinhood do is they take the opposite of every single trade that Robinhood customers make, and then they hedge with index futures. And what that means is if Robinhood customers underperform the market by 5 to 6% per year, I don't know what they do. It's probably even worse. That drops into the pocket of the people who take the other side. And then they take the market risk out of it by just hedging with index futures. It's good work if you can get it. The idea is that what I noticed was that Robinhood was making 10 times what the other firms were making. And I was like, why? And that was the question I asked. We still don't really know why. I mean, we think this is why. Like, we think that they just take the opposite side of everyone who trades with them. And if you take the other side of everyone who trades with a retail broker, you make money. Like, because not only that, but they're lending them interest. They're lending them money to trade at 5-6% interest. So what happens is you can force margin calls and you can buy it. You can buy stock cheaply from your customers. So that's how they do it. They deal the bid-ask spread. They take the other side of all the trades, and they're lending money above market to the customers, which creates problems for the customers because they don't know how to handle it and they just lose.
Right. So is the implication here that Robinhood's clientele is 10 times less efficient at trading than that of a client at TD Ameritrade, let's say? Is that the implication that would tell you?
So what we learned later was that some of this value comes from some of the reasons why other brokerages were getting less is because they were filling orders internally. So what they would do is they would find another customer who wanted to do the same thing, and then they would buy and sell from their customers, and they would facilitate these trades. But they would so they would make markets and stuff, and the stocks of their customers would trade. So that's like a little meat that other brokerages would take off the bone, but Robinhood would leave it on the bone for the high frequency traders. So that's why the order flow is more valuable for part of it. But the rest of it is that Robinhood customers are dumber than other brokerages. Like, it depends on the brokerage. Like Fidelity would be a good example that a lot of institutional investors use. So if orders are just streaming in from Fidelity and you're a high frequency trading firm, you might get run over. Like, they might know something about the stock that you don't know. But if Robinhood traders are doing the same thing, then it's less likely that that they know something that the high frequency traders don't. Does that make sense?
It does. So you're saying that TD Ameritrade would take the juiciest of their order flow and make markets in-house before routing it out to a Citadel type of place. Is that correct?
Yeah, presumably. And obviously, it's difficult to understand why some of this stuff is happening. There's a lot of misinformation out there, like Robinhood in particular isn't very transparent about what they're doing. It's not good for retail investors. Like any of this stuff is not good. It's a conflict of interest. I don't think Robinhood is the devil per se, but I do think their customers deserve to know that Robinhood and their friends trade against them. What I really would like to see is if Robinhood would publish what percent of their customers make money in any given month and year. So like if Robinhood customers could see that, hey, 80% of our customers lost money last year, like I think that would be kind of interesting,
Yeah. So I'd just like to touch back on something you mentioned earlier in the interview. And you're talking about how bottom-up value funds, or just funds in general, how at a time like this where valuations are kind of expensive, that it's either maybe pile into some less than great ideas or give back your capital. And, the incentive there is usually to not give back the capital, not take themselves out of a job. And that sort of pairs with an article you recently wrote where you mentioned that there's typically two types of Wall Street fund managers, and one of them will, raise some money, blow it out of the park, make, something like 50 or 100 million. And after 2 years, they would reach their quote unquote fuck you money and just go retire. And that would be done. They'd invest their own money. And then there's those ones that want to build an empire, like a Carl Icahns of the world. And you mentioned how the building of an empire approach might not be that good for the investors in the fund. So I would really like to hear your input on this dynamic here.
Yeah, for sure. I mean, let me ask you this question. What would you do? Let's say you are a talented fund manager, a quant, and you raise $100 million for your fund. So let's say 5 years in, you made a decent return. You pocketed $30 million, right? So do you want to raise a bunch more money, or do you just want to keep the money you have until you get to 100, 150 million and just quit?
Yeah, I think I would probably quit. I'm not sure.
I think I would. I don't have a whole lot of desire to be a billionaire personally. Like I would walk away after $100 to $200 million. I just would. I think there's so many headaches. Like to grow bigger, you start to have HR headaches. Your transaction costs increase logarithmically with the amount of capital you have. So it becomes harder and harder to beat the market. Liquidity becomes more of a problem. It's just not as much fun. Like I feel like on $100 million fund, I think I can pretty reliably crush the market. I can't say the same if I had a $10 billion fund. And $100 million fund would be more than enough to, over time, the fund grows. You retire $150 million in the bank. Life is good. I'm a little suspicious of people who would want to be billionaires and who would want to continue to like pile it on. Just because your priorities are probably not with your family, with your close friends, and that your priorities are more towards building an empire. Not universally true, but I don't know if I would. I don't know if I would like having all that attention and power.
Right. So, why do you think maybe these empire builders? Why would maybe the interests of the investors in their fund and the empire builder themselves diverge?
Well, the most obvious reason is that as your fund grows bigger, your transaction costs increase to run the same strategy. So, like, we can, like, if we're a very small trader, like, we can get away with using these patient limit orders and stuff. If you have a $10 billion fund, you can't fucking do that. Like, you can't provide liquidity all the time. You're gonna have to take it. It's impossible. It'd take you a month to get out of a stock, you know. Even like with futures and stuff, you'd have to take the other side of possibly informed order flow. Like if somebody's just dumping S&P futures and you're taking them off their hands, like they might know something that you don't. So you start to incur transaction cost, and it can start to erode the alpha of your strategy. Also, there's more distractions. HR is something I mentioned earlier. Like if you're Bridgewater, like I think 20 years ago, I think they might have had 50 people. Now they have like, I don't know, it's either hundreds or it's over 1,000. Like how many people in that fund participate in investment decisions? Like 6, 7? Like not very many. The rest of the people, they market the fund. And that's what you see with these big funds. Is that the emphasis is on asset gathering as opposed to performance. And that's also what makes funds big. If their marketing department is running the fund, then you could expect the performance to not be that great. Because what's your focus on? Is it growing assets through a return, or is it growing assets through raising capital? Because it's arguably easier to raise capital, especially if your investors don't require that high of a return. So if you can say, hey, I'll get you a 9% return, that's not correlated with the S&P. So that's kind of what Bridgewater does. And that's a good deal for institutional investors. It's a good business model for Bridgewater. But you know they could get 25% a year if they just ran a small amount of money and focused on their core strategies. They would make less money, but they would probably have simpler, easier lives.
Okay. So maybe you can talk about, as I've mentioned, currently the audience is more focused on short-term traders. Maybe you can talk about the time frames they use versus you use, and how they can maybe extract more returns by changing that, or just using a strategy that's more focused on their time frame.
Yeah, so like the shorter the time frame that you're trading, the harder, the more intelligent your competition is going to be, and the harder it is for you to make money. So on a very short time frame, your strategy should look something like market making, and that requires investment in infrastructure and data, and like you need a very good understanding of market microstructure. You need auto quote software. You need a lot of this stuff, and if you don't have that, like you probably don't have any business day trading. I mean, you can try it as a hobby, but I would not try to feed a family like day trading, you know? And this is also true for like, you know, a time frames of a few days. You really need to understand what your edge comes from and how you're making money. So I think at a minimum, I think a 1 week time frame would probably be a good idea for somebody, especially if they're not loving the way their trading is going. I think imposing a 1 week minimum time frame on trades, because it reduces transaction costs, and you're allowed to pocket more risk premium that way. So like I'll give you an example of like your transaction costs as a percentage of the profit that you make is a very good indicator of how successful your strategy is likely to be in the future. So if I have a strategy that racks up $1,000 a week in commissions, it's going to be very expensive if it stops working. Does that make sense?
It does. It does.
Now, if I have a strategy that's $100 a month in transaction cost, it's less than if it stops working, or if it stops working as well, I'm not going to be in the house of pain. Like this is a very important thing, because my first couple of years of trading, I racked up a lot of commissions. I think I racked up $20,000 in commissions by the time I'd entered college. that was all money that did not need to be spent. It was, when I started out, it was $13 a trade. Now with interactive brokers, it's $1. Like, this is important. So managing transaction costs for the active trader is very important. You got to approach this like a business, and a lot of people don't. They just say, "Hey, I'm going to develop better strategies." But reducing transaction costs is free money. Like, if you're paying over $1 a trade, like you need to rethink your setup, and you need to move money. You need to get a more professional setup, because you're guaranteed to lose money if you're paying more in cost. So just don't do that. Same goes for margin. Like, I work as a consultant to high net worth investors, and this is a pretty common theme I see in people's portfolios. I'm like, you're overpaying for margin. They're like, what do you mean? I'm like, don't do this. Like, I'm like, you're paying like 4 or 5%, and this is like, you don't need to be paying more than like 1.9 in the derivatives market. So we reshuffle their portfolios so that their exposures are the same, but their interest rate's less. And usually they walk away $20,000 a year richer or more. It's very, very interesting how people overpay for stuff. So don't overpay for margin. Don't overpay for commissions. Like, if I get it if you have a trading strategy that you believe in and it just doesn't work, and then you end up pivoting. But don't shoot yourself in the foot if you're an active trader, especially.
Right. So, of course, there's probably some active traders listening to this that they do make consistent profits in the market. And, it's unlikely that they would listen to your advice on this. So, assuming they ignore this advice, what, outside of transaction cost reduction, is there something that a day trader who's, we assume they're profitable, is there something they can do to even further augment their returns?
I don't know. I mean, I'm not completely opposed to day trading, because I did day trade a lot when I was younger, and I did have success doing it. A lot of Tesla, a lot of Apple. I don't really know. Like, a lot of people trade by feel. That's kind of how I started. Trading. I started trading by feel. It worked, but not as well as the quantitative stuff. I would just say, if people are happy with their system, go for it. Just measuring performance, tracking performance, knowing transaction costs. That's helpful for getting to where you want to be. Also, understanding options. A lot of people just don't understand options. They overpay for options. They sell them too cheap. So just understanding some options theory. Oh, there's another freebie, Pat, that I can give to people. On hard to borrow stocks, you can synthetically create the stock using options, and you can pocket money. Like, the brokerages pocket the money from lending the stock normally, unless you're in the lending program, and even then you only get 50%. But you can make these positions synthetically, and you can pocket the short borrow rate yourself. Just a little dry theory for people. And also, what you can do is you can create these synthetic positions to get around margin interest rates. So, like, if you wanted to, as long as you have the margin, like if I wanted to create a leverage position in Apple, what I could do is I could buy and sell premium. Like, I could sell puts and I could buy calls for how much Apple I want to buy, and then I would be paying the LIBOR rather than my brokerage's interest rate. And you got to make sure this works for your brokerage's like margin rates. You got to size the position reasonably, but you can get around rules on margin using options. There's a lot of cool stuff you can do with options theory. So I would say, like, the only products that I want to trade going forward are options, futures, and ETFs. Actually, so for the credit strategies, we use mutual funds, but that's just parking cash. That's not a trading strategy. But as far as trading goes, I think those are the products that people should focus on.
Right. So, do you have an article maybe or a book that might go into more detail on making synthetic stock positions?
Let me look. I wrote about Beyond Meat in this context a while back. I published it June 24th. It's called How Option Theory Can Make You Extra Money in Cannabis Stocks and IPOs. And that's it goes over the theory on this. It's a freebie for people, so that there's really not a lot of risk. The only risk is if the short borrow rate increases in the interim, the puts can get more expensive and the calls can get cheaper, which is bad. If you keep your time frame short, it won't matter because it'll converge to parity or to par. So usually a 1 month time frame is what you would do on a trade like this, like 1 to 2 months maximum.
Right. So, all right, I'll definitely link that in the show notes. And I do remember reading an article related to this topic about Tilray and how you said traders couldn't get around the borrow rate by buying puts because there was so much premium in the puts. So maybe a stock like that, is there a way to maybe creating a spread or something? Is there a way to create a synthetic stock position that costs a bit less than the borrow rate? Because it seems like the listeners of this podcast are probably dealing with that a lot, given that they often trade low float stocks and this sort of thing.
Yeah. So the idea is if you wanted to short Tilray, it depends. I wouldn't feel confident about shorting any stock that's low float unless you have a very strong catalyst with a very short period of time. But what you would do is you'd just flip it. So you would buy a put and you'd sell a call. And this would create a synthetic short position. And you'd pay the wholesale rate rather than the retail rate your broker would charge you. So you'd do a little better. I don't know. I still don't know if it's a good idea. But you'd be able to do better. What I like better in these kinds of positions is actually capitalizing on the short demand and the put buying by retail investors. So the idea is that a stock like Tilray or Beyond Meat, like the lockup is like 4 or 5 months away. And you're still getting these short squeeze conditions and you put on these options trades. And you're earning premiums in excess of 100% annualized. So ordinarily your broker would just pocket that money, but that actually provides some of the theoretical framework for a stock like Beyond Meat staying high for as long as it did. It's just that there's money to be made in that trade, and the market makers have to buy the stock to hedge.
Gotcha. So something I really wanted to talk about with you was your book. So you published a book not too long ago called High Finance. Can you tell us a bit about that and what inspired you to write it?
Yeah, for sure. So High Finance was a lot of my earlier work on investing. I published it, I think, 2016. Yeah, I was 21 when I published it. There's parts of the book that's out of date, but it's a really good introduction to the financial markets for a beginner, even an intermediate investor. And then the idea is you start with that, and then you go to my articles, and you can learn more because the articles are more technical. I can write an article on a more speculative or theoretical topic, and I'll only invest a couple hours in it, or I don't know, 2 to 3 hours. And then if people don't like it, then that's fine. It's harder to write a book on something more speculative and theoretical. So the book is just the basics. It pays my grocery bill and my phone bill. The book does. Get nice royalties off it. So if anybody's listening to this and wants to buy it, it's a good book. There's some things in there that most investors won't know. There's some stuff that's out of date, obviously, but it's a great introduction to finance and to making money in the markets. Awesome.
So, you publish a lot on Seeking Alpha. Obviously, you wrote the book. Being an investor, what makes you so interested in writing and research? Was there a catalyst that caused this, or?
I don't know. I do like writing for Seeking Alpha. I mean, anymore, I just write a couple articles a month for them. It's a great way to get feedback from people in the finance community on ideas. So if I have a big enough following now, it's a little less than 5,000 people on my email list. Or I can write about pretty much any topic, and I'll get feedback from institutional investors and professional traders who trade independently. So that's pretty valuable. Like a lot of these theoretical things that I know, a lot of the stuff I learned from my readers. So they actually, they probably don't think of it this way, but they actually help me develop my strategies. And they help me develop my models too. So when people comment like, what do you think about this? Or what do you think about that? Or this theme or that theme? And then I look at it and I'm like, huh. So my models get better that way. And there's really no need for secrecy in the kind of stuff that I do because it's not short term and it's not focused on individual stocks. So I can't really affect the price of the S&P 500 or of the 10-year treasury or anything like that. So when I make these models, there's really no downside. There's no downside. And I make a little money off SeekingAlpha too. It's not much, but it pays for some vacations.
Awesome. So I think you've definitely shed a lot of insight on some things that maybe the listeners haven't thought about before. Assuming that an active trader with a shorter time frame is listening to this, is there anything you'd like to leave them with?
Yeah, just approaching markets like a behavioral economist rather than always looking at intuition and gut instinct. There's nothing wrong with intuition, but a lot of times you'll want to test it against known theories and ideas of asset pricing. And if you find out you're on the wrong side of it, then you might shift your approach in some cases. So one of the things that I've kind of popularized is this idea of risk parity and of trading interest rates as well as stocks. So I would say if even short-term traders, if they're looking for a new product to trade, I think Treasury futures are a very interesting product in particular. The idea is with stocks, right? You buy low, you sell high, you pocket dividends in between, right? Now, the idea behind a lot of the interest rate strategies is you borrow short and you lend long. And that's a strategy that doesn't necessarily correlate with the stock market and even correlates negatively. So if you're buying or if you're selling cash and you're buying the 5-year treasury, there's a risk premium embedded in that. So depending on the levels of those two products, or cash in the 10-year or cash in the 2-year, you can actually set the leverage of that strategy equal to what you would want in the stock market. You can make money. So what you find is that these strategies do very well in times when stocks do poorly, and it allows you to take more risk than you can take otherwise. So just people opening their minds a little bit, I would say currencies are another really interesting place to look at. Commodities, I have models for currencies and commodities. The more independent opportunities you can find, the higher your chances of making money over time. Which is, if you're an active professional trader, that's what you live for. You want to have as many opportunities as possible and as many markets as possible.
All right, that's a great way to close it, Logan. I gotta really thank you for coming on. Some really good information today.
Yeah, no problem. I hope it wasn't too theoretical.